Not every news moves the dollar, only these few data points really matter. Many traders in the Forex market make the same mistake. They follow too many news events at once. The dollar may still move, but rarely in the way most people expect. If you want to cut through the noise, you only need to watch 4 key elements: inflation, employment, the PCE index, and the tone of the Federal Reserve. The rest of the news, in most cases, is just background noise. First, there's inflation, but not every inflation number carries the same weight. The CPI is important because it arrives quickly and creates initial shock. That is why the first move in the dollar often starts right there. Today, the market is closely focused on the US CPI release, and the exact timing is already on everyone's calendar. For example, the March 2026 CPI data was scheduled for April 10 at 8:30 a.m. Eastern Time. If you are looking for a report that sets up the first move in the dollar, CPI is still one of the most important indicators. If you want to see what the Federal Reserve actually watches the most, you need to look at PCE. The Fed itself has clearly stated that its long-term inflation target is measured using PCE, not CPI. According to the latest official data, the U.S. annual PCE in February 2026 stood at 2.8% down from 2.9% in December 2025. Anyone who wants to follow the true path of monetary policy cannot rely on CPI alone. In the end, the market returns to PCE because that is where the Fed adjusts its decisions. The third major piece of the puzzle is employment. The most common mistake that many traders only focus on the non-farm payrolls or NFP and ignore the rest. The labor market is not just about the headline number. The combination of jobs, unemployment, and early signs of fragility in the labor market is more important than a single figure. Recently, the Federal Reserve clearly stated that in the current environment, there are risks in both directions: downside risks to the labor market and upside risks to inflation. That means if the employment data slows down more than expected, the dollar can suffer through shifting rate expectations, even if the other data are not obviously bad. Next, there's what many traders underestimate: the tone of the Federal Reserve. The market reacts to the raw numbers, but the way the Fed interprets them often has a bigger impact. Recent meeting minutes and comments from Fed officials show that the current stance relies heavily on patience and on letting incoming data guide policy, not on rushing into a new direction. When Chair Barr explains that the current policy level is a good place for pausing and evaluating the data, or when Jefferson highlights both the risk of higher inflation and the risk of weakness in the labor market, that sends a message to the dollar that goes beyond a simple headline. The market prices in two competing risks at the same time rather than waiting for one clear-cut outcome. There is a more advanced point underneath this. Not every data release is a trend maker. Some reports mainly create short-term volatility, while others help shape the longer-term narrative. CPI usually creates the first shock. PCE usually shapes the story of monetary policy. Employment data, when they are clearly strong or clearly weak, can shift the entire path of rate expectations. The Fed's tone decides which one of these three carries more weight at any given time. If you do not combine these 4 layers, you will constantly get caught in short-term spikes and fake moves. There is one more layer for 2026. The market now looks not only at the numbers themselves, but also at their second-order effect. For example, the Federal Reserve has pointed out in a recent research note that tariffs implemented up to November 2025 added about 3.1 percentage points of pressure to core goods PCE and roughly 0.8 percentage points to overall core PCE by February 2026. This means the dollar's market starts to question whether certain inflation pressure are classic or something more structural, and that makes the Fed's job more complex. When you see the dollar reacting unusually to a seemingly ordinary data print, it is usually because the market is reading both the number and the story behind it. If you want to read the dollar correctly, you do not need to chase dozens of headlines. Instead, focus on which data creates the initial move and which shapes the direction. CPI is the main driver of the first shock. PCE is the key window into the Fed's thinking. Employment data helps price the path of interest rates. The Fed's tone decides which of these three market will treat as more important. Everything else, in most cases, is just noise. Among these four, inflation, employment, PCE, and the Fed's tone, which one has surprised you the most in your dollar trades so far? Share your experience and tell us which piece of information caught you off guard the hardest.